This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now we're going to look at the internal auditing function. Corporate governance says that listed companies should annually review their need for internal audit. If you remember, in governance they must have an audit committee and they have to keep under review the need for internal audit. An internal audit, a definition, is an appraisal and monitoring function to assist members of the organisation in the effective discharge of their responsibilities. In general, internal audit is going to report to the audit committee, but the head of internal audit may also report to the board on particularly important matters. But if you remember, we said that the audit committee can give internal auditors much greater power, much greater security really, if they have some criticisms to make of the way the company is being managed. If you're not reporting to an audit committee, you're probably reporting to the finance director, and the finance director has maybe a vested interest in covering up some problems with the accounting system, because ultimately the finance director is the one who's directly responsible for that, but reporting to the audit committee gives that bit of almost impartiality and power and so on to the internal auditors. The CIMA guidelines on internal audits are these. The aims of the internal auditors should be agreed by the board, and we've seen that right up to the board goes all really the mechanisms of or ultimate responsibility for risk management, and internal audit is one of the weapons you have for risk management. Most internal auditors probably spend most of their time looking at accounting controls, but it doesn't just have to be that. It could be looking at, say, compliance with health and safety rules, maybe making sure some quality methods are properly implemented, perhaps making sure that the recruitment policies and methodologies comply with the law. They should have full access to people and documents. This should be given to them by the company. External auditors are given this access by law, but internal auditors have to go perhaps slightly cap in hand to the company and said, we need to see the board minutes. And if the company says, no, you can't see the board minutes, then the internal auditors don't really have the power of statute behind them. They should have clear access to the Chief Executive Officer, the Chairman and the Audit Committee. They will report to a Senior Director or the Audit Committee. They are independent of executive management, so they should be independent of the Finance Director so far as possible. It's very much almost an overseeing and a checking procedure, so they need his independence and almost a professional skepticism to be able to properly report. They should keep themselves up to date with best practice. We'll see some of the modern techniques of computer-based auditing can be extremely effective. They should be consulted in all major business changes. For example, if you're suddenly deciding you're going to open up a branch in America, then obviously there are internal control implications of that. And better that internal audit gets in at the start of maybe designing the new company or designing the reporting arrangements, rather than having to repair something later on. No operational involvement elsewhere, clear communications of findings, and indeed their performance should be regularly assessed as well. So everyone's performance is assessed, the internal auditors, the board, everyone else in the organisation, to make sure that everyone's pulling their weight and doing things properly. The type of assignments that they can be involved in is very, very wide here. Transactions audit. For example, it could be following through what happens when an order comes in from a customer. The credit limit should be checked. You see if there are goods. You dispatch the goods. You make sure the invoice is raised. You post that to the receivables account. You follow it up and you match the cash when it comes in. So you're following through the transactions, perhaps quite high volumes of them in some cases, to make sure they're being handled properly and securely. Systems audit really looks at IT systems, particularly looking at maybe the security in IT systems, access control, input controls, and so on. A risk-based audit, looking at where the company's particular risks might be. So they can allow the board is ultimately responsible for risk management. You could assign a job to internal auditors, looking to see what are the particular risks involved in exporting particularly valuable machinery to a particular country. How should we make sure it's not damaged or stolen, that it goes to the right people, that it gets there on time, and so on. Obviously, the internal auditors are not responsible for, booking the shipping and deciding who's going to do it and so on, but they could maybe give some useful kind of independent views on how well the supply of the goods is going. One of the major assignments is looking at the accounting systems. How do we make sure that, for example, all overtime has been authorized, that invoices from suppliers are not paid twice, that amounts are debited to the proper account in a nominal ledger and so on. And this is primarily done through a system of internal control in any well-organized company, that the system is set up in a way that you hope nothing can actually go wrong. It's a kind of watertight system. Operational audits. Operational audits could be looking at maybe the operations of, say, accounts receivable. How well are we organizing that? It could be looking at the operations maybe to do with internal, the quality controls and so on. Does it seem to be working efficiently? Social and environmental audits. Social, they could be asked to look at the ethnic background and the male-female ratio of staff to make sure that we are following the proper non-discrimination kind of diversity program that the company wants us to follow. We could be looking at environmental audits. What percentage of packaging are we recycling? What's our carbon footprint like? Are we managing to save power year on year and do things more efficiently? Have we released a lot of noxious liquids into the local river? They're always going to be available for special assignments. So someone discovers that a fraud is going on, you immediately want to know, how much is involved, how long is it been going on for, who's involved in that, how can we stop it? Value for money audits tend to be, we tend now to be speaking to government or not-for-profit organisations here. How do we know the taxpayer or the council taxpayer is getting value for money for this, the amount of taxes being levied here? And we tend to look there maybe at effectiveness. What should the council be doing? What sort of services should it be undertaking? Is it doing that efficiently? So decide what you want to do and then do it efficiently, and then do it with reasonable economy. Take reasonable kind of commercial viewpoint in getting a good deal. If you're buying in equipment, go to 3 suppliers, make sure you get the best deal. They can be involved in identification of risks, and finally they can be involved in the review of compliance. You don't have to learn those off as a list, but it's just trying to show you that internal audit is more than just looking at the financial internal control system. It can be very, very wide indeed. There are significant differences between almost the status of internal and external audits or auditors. If we look at who they report to, internal auditors report to management, probably via the audit committee. External auditors are there to report to shareholders on whether the financial statements show a true and fair view. Internal auditors are appointed by management and therefore of course might be slightly beholden to management for their jobs, and there can be independence issues here. However, external auditors are reported to shareholders. They are the servants of the shareholders. Internal auditors get their power from management. Management can determine what documents you can and can't see. In external audits, it's a power of statute which says that external auditors have a legal right to see every document they want and to get every explanation they require. Internal auditors are often employed by the company, and again they will be maybe going carefully to make sure they keep their jobs or get promotion, although it's becoming increasingly common to actually outsource the internal audit function. So you get a rather paradoxical internal audit which is supplied from outside. External auditors are always outside independent firms of auditors, and we get a lot of independence from this that is maybe lacking a little bit because of the employment relationship. As we've seen, internal auditors, huge variety of risks and huge variety of undertakings that they can be looking at, whereas external audit tends to be very focused on the financial statements. And finally then, improvement of what's going on is one of the major functions of internal auditors to see flaws in systems and to suggest improvements in efficiency, in reliability, in tidying up areas that might be susceptible to fraud. It is not primarily the duty of improvement, it's not primarily the duty of external auditors, although if they see some flaw in the internal control system, they will tell that to management and hope that it will be improved for the next year. The quality of internal audit. How good are your internal audit teams going to be, and therefore their internal audits? And what we want really is organisational status. Is there a reasonable degree of independence? Can they be sufficiently objective? And one of the ways in which you get that is allowing them to report to the audit committee. You can also get it if there's a reasonable number of them. If there's only one internal auditor, it's a pretty lonely life. But if you have four, they can give each other some mutual support and so on. And it's particularly useful also, they're members of a professional body. There's I think it's the Institution of Internal Auditors, or the Association of Internal Auditors. And if there's a problem, you can ring up your professional body and get some help. We want to make sure that they're competent, that they have the proper training, that they have time, that they have the right resources and so on to do their work. You're not going to get a very good, satisfactory internal audit done if people have not got the time to do it, or not got the training, and not got the resources. And we want to see a good systematic approach, proper documentation, proper planned audits with objectives. We know what we're going to do, we think about how we're going to do it, we follow what's called an audit program, which tells you what to do, tells you how many documents to look at and to test, tells you what to do if you find some of them are not compliant, and so on. And you need to carefully document what you find, because this can be evidence later on when you are presenting findings to the board or to the audit committee. Now, all auditors really use an audit risk model as their approach to auditing. And what the audit risk model is essentially saying is that the ultimate sin really for an auditor is to report that something is fine when it's not. So that's what's known as audit risk. Audit risk is the risk that the auditor says everything's fine when in fact there's a big problem. So for external auditors, it will be saying the financial statements show a true and fair view, when in fact there's a material misstatement in them, a material error in them. For internal auditors, it could be saying this is working fine, no invoices are being paid twice. It could be saying the credit control function is operating properly, when in fact it is almost defunct. How do we minimize the audit risk? Because we want to keep this here small. Yeah. Think of the embarrassment if you were an auditor and you came out with the wrong conclusion at the end of your report. And there are three components kind of to getting this wrong. First of all, you have what's called inherent risk. And inherent risk is the risk that an error is made in the first place, before taking any controls into account. So the sort of things that would contribute to inherent risk in an organisation, either producing its financial statements or just recording amounts in the ledgers, could be how skilled are your staff, how experienced are your staff. So if there are new staff, inexperienced, with maybe poor supervision, big chance you're going to make an error. If it's very complicated transactions, lots of futures and options and things that you record the wrong way, you misunderstand what's happening. If it's something to do with deciding what profit to take in a long-term contract, again, there's a big chance, because of the complexity of the transactions, an error is made. Or if somebody's under a lot of time pressure, how are we going to make sure that, in a hurry, errors are not made? So that's the first thing. High inherent risk is bad news. Second thing we can look at is in the control risk. So the control risk, or the controls, are, okay, an error is made, but if there's a good system of internal control, then we're going to detect that. We're either going to prevent the error or detect the error. So the control risk is high if really the company's a bit of a shambles. If nobody is authorizing stuff, as nobody is doing any sort of reconciliations, or nobody's really doing any sort of supervision, this means that an error can have happened and then it is not picked up. So in a way, the error has either now got into the financial statements, or the error has potentially got into the ledgers. A wrong amount has been posted, if you like, maybe to a normal ledger. So an inexperienced person posted it initially, nobody checked it was being analysed properly, the controls were poor, and so it's landed up as an error in the financial records. Your last line of defence, really, to stop this error then going on and doing some damage, is what's called the detection risk, and this is the risk that the auditor doesn't find this error. To get the audit risk small, if this is small, so very simple transactions, experienced staff, loads of time, and if this is small, a very kind of watertight, well-controlled, well-supervised system, the chance of an error actually getting into the financial system is really rather small. So the detection risk, you can actually afford that to be rather high. You don't have to do as much work, because the chances of something going wrong are actually quite small. But if what you discover is inherent risk is very high, you've got lots of new people, they don't seem to be knowing what they're doing, there's bad leadership in the accounting department, complex transactions, there's no controls worthwhile, so almost certainly there are going to be errors in the financial system. The only way you can get this low is to this low. That means doing lots and lots and lots of auditing work, because you are the only line of defence really between errors being made and then them getting into the financial system and actually doing damage. You're the last chance. So what the auditors do is they up and down their amount of work. They can vary the detection risk really in response to the inherent risk and the control risks. Detection risk, what is the chance that the auditors don't find a problem? And this depends on two things. First of all, there is sampling risk. So if you were to look at just 10 invoices, let's say half have been processed correctly, half have been processed incorrectly, do you see there's maybe a reasonable chance that you pick out 10 at random and you just happen by almost bad luck on sampling to pick 10 good ones. And if you pick 10 good ones, you'll probably run off with the conclusion that everything's fine. But if you were to extend this maybe to 50, increase your sample size, and you draw 50 at random out of the file, and the chances then, if it's kind of 50% right, 50% wrong, the chance of you only picking 50 good ones and not picking up any bad ones at all is obviously much reduced. So the bigger the sample you look at, then you are reducing the detection risk. But of course it takes longer, it's more expensive. It's a matter of judgment and balance. The other sort of risk that auditors can run so that they don't discover errors is what's called non-sampling risk. And really this is, in a way, the auditor not being experienced enough to know what they're looking at. So we could look at 100% of items. Let's say it's some sort of complicated futures kind of contracts, and we don't know very much about them. We haven't come across these very often. You could give an auditor 100% look at all the futures contracts, but if they didn't actually know what they meant, if they couldn't interpret them and so on, then the auditor's kind of wasting their time. So sampling risk, you get over that primarily by better training, people of higher experience, maybe better supervision of what people are doing, so that a number of people maybe review what's happening, and it eventually goes through someone who does know what they're kind of talking about. The stages of an audit, this is in a way drawn up for external audits, but it's easy enough to adapt to internal audit. The first thing you need to do is to plan. And a lot of the planning you're going to be doing here, it will be looking at risk areas. So if you're dealing if you're the internal auditor of a jewelry shop or a chain of jewelry shops, you know a big risk area is going to be inventory, small, high-valued items, probably easy to mix up diamonds or something, put an entirely different value or wrong value on them and so on. So that's going to be a high risk in a jewelry business, and therefore you're going to have to spend, to do a good audit, quite a bit of time in inventory. If you're in maybe a supermarket, then maybe the high risk there is cash. So a lot of the transactions are cash, and obviously cashiers or other people could be stealing cash and so on. You also need to plan almost the size of the audit here. How big is the factory we're going to visit tomorrow, part of the company we're working for, we're internal auditors. Should we take 2 auditors, 3 auditors, 5 auditors? How many auditors do we need to actually check the inventory and so on? And this allows us to assess the risk of either material misstatement or material errors in the financial system, and then we respond to that. Primarily by upping or downing the amount of detection risk we're willing to experience. If we think there's very high risk of an error, then we're going to respond to that by doing more work. Now, most decent companies, most big companies, they will have a system of internal control, and most auditors will embark on testing the system of internal control. This allows them to place reliance on the staff themselves, in a way doing self-checking or checking by a colleague, and it means the chance of an error getting into the financial system is relatively low. So what the auditors will do is they will test the controls, and if they're satisfactory, then you may just look a little bit directly at some figures. So it looks as though from the test of controls the inventory has been recorded really accurately, but then you might go and count 5 items or something. That's really a substantive test when you go to the figures directly, rather than a test of control, which is where you look at the controls. So you think the controls are working right for booking in and booking out inventory, and then just to kind of put the icing on the cake, you go and look at 5 items of inventory, count them, compare them to the book stock, and if it's all right, then it's even more confidence. However, very often there's supposed to be an internal control system, and it's not working very well. It's kind of fallen into disuse a little bit, and sometimes when you test these controls, you see they're not operating, and then the auditor has to go. They would report significant problems there to management, but they have to do full substantive tests. So if the auditor's concluded that inventory's been booked in and out very badly with no controls, really the only way you can assess how much inventory there is and maybe whether it's been stolen is to count all of it. So that's a full substantive test, to count all of it. If in a supermarket you're not confident that cash is being handled very well, that people don't seem to be maybe ringing up the tills and producing till rolls and reconciling what's banked to what's on the till roll and so on, then maybe what you have to do one day is to go in and count all the cash and all the tills to see if it properly reconciles. And then at the end of all of this here, they'll come out with some sort of auditor's report. In external audit, the auditor's report will go to the shareholders. In internal audit, the auditor's report will go to the, first of all, probably to the audit committee and maybe ultimately to the board. Everyone's going to be recording and assessing the accounting system. I don't want to spend too long on this. You can't really audit an accounting system without probably documenting, really understanding where the documents go, who authorizes, who reconciles, who makes sure that a document is cancelled when it's finished with, and so on. So you can have notes, you can have flowcharts, you can have questionnaires here. And one sort of questionnaire is an internal control questionnaire. And there the answer yes is going to be good. So it could be, is overtime authorized? By the manager. If you get the answer yes, there's a kind of a control which seems to be an operation here, and then you go and look at some overtime sheets or look at some time sheets and make sure all of them bore the signature of the manager. Can we turn round a little bit to an internal control evaluation questionnaire, which would be more like can unauthorized overtime be paid? There you want the answer no. But it's not quite telling us why it's not paid. It could be because everything's authorized, but we could have got the answer no simply because they never pay any overtime at any time at all. Authorization is kind of irrelevant. This here, this internal control questionnaire, can be done by someone of much less skill and experience. You give them a very pointed question here. Is overtime authorized by the manager? Yes, and you can go and quickly gather evidence about this. This, you're leaving it up to somebody's judgment a little bit more. Can unauthorized overtime be paid? And there might be a number of different ways which are effective in stopping that being paid. Auditors of all sorts need to look for audit evidence, and these are the only 5 ways of collecting audit evidence. Audit evidence that things are going right, or there may be some problem that we need to investigate. Analytical procedures is basically kind of comparisons maybe ratios. So if you saw that last year's gross profit percentage was maybe 30% and this year was 45%, that's a pretty clever trick. Maybe they've done it, but maybe it's indicative of an error. Maybe they haven't accounted for inventory properly or accounted for purchases properly, and this has put up the gross profit percentage to 30 to 45%. This is extremely useful at an audit planning stage. If you saw gross profit percentage one year was 30% and the next year was kind of 30.5%, that's kind of not arousing your suspicion. That's probably saying there's not a big surprise in there. It's a little bit of evidence that probably things are going correctly. Inquiry and confirmation. So someone is supposed to, as goods come in from the suppliers, someone is supposed to count them, to look for damage and so on. Obviously you could ask that employee, and do you inspect goods as they come in? And of course the employee is going to say yes. So inquiry is a form of evidence which is actually very weak. Confirmation tends to be a term used if you get basically evidence from a third party. So in assessing how accurate the receivables ledger is, it's common for both internal and external auditors to do what they call receivables circularization. In other words, you write to your customers and say, did you owe us, say, $2,500 at the 31st of December? And if they write back and say yes, they have confirmed not only that the amount is right, but probably that the receivables accounting is working quite well. If they write back and say no, it isn't, you have to discover why. It might just be a simple timing difference. You sent out an invoice on the last day of the year that the customer hadn't recorded yet. Inspection, very good form of evidence. What you'll be doing by inspection, you could be looking at the overtime authorizations. Has somebody actually signed it? You can be inspecting the stores. Do things seem to be locked away nicely and so on? Are they being kept secure? Are they being basically held in an ordered, secure, safe way to prevent damage? We can also look at tangible assets. We can inspect, is inventory actually present? Are the non-current assets actually there? This is really, really powerful sort of evidence that the auditor can use. Observation. So we joked here, you're going down to the input, the receivables bay, and you ask somebody if they're doing something. Well, instead of just asking, why don't you observe them doing it? Watch them look at goods as they come in and see whether or not they do count them, look at them for damage and so on. Of course, you can be changing their behaviour. They know they're being watched, so you maybe have to use a certain bit of kind of, looking over here and kind of pretending to look at them. You need to maybe use a certain amount of guile to do that properly. And then this is the AEIOU, is a bit of a false U there, recalculation, reperformance. Auditors think that a bank reconciliation is being done properly, but how do they know it's been done properly? Just because it says, here's the balance by the bank after adjustment, here's the balance in the cash book, and they agree. How do you know that someone's actually gone through and looked at the unpresented checks and all the timing differences, and that they haven't just filled in almost random numbers to make it look as though the two figures reconcile? So auditors have to go and actually recalculate things sometime. Wages very complicated very often to calculate. How do you know we're doing that correctly? You have to really recalculate. You can't really prove it by just looking at it. Computer-assisted audit techniques. Computer-assisted audit techniques. Most companies of any size now, of course even very small ones, will keep their accounting records on computer. And this means they're susceptible to specialized techniques. An audit program, this is the auditors. And basically what it does, it reads through the client's records, interrogates it. So it's the auditor's program examining the data, the client's data or the company's data. It can select samples to investigate. For example, your random sampling, you want to select 100 transactions out of maybe 10,000. You get this to randomly select 100 items. You can reperform calculations. How do you know that the age receivables report has actually been sorted properly? 30 days, 30 to 60, 60 to 90, over 90. If it's making an error, then you think hardly any old debts, perhaps. How do you know that the inventory file actually adds up to what it says at the bottom of the printout? And then you can look for unusual items. You can look through 100% of the transactions here and find unusual items. For example, credit balances on the receivables ledger or negative stock balances. They shouldn't really happen and they need investigation. Test data is the auditors. And this here you subject to the client's or the company's programs. So are the programs operating correctly? Are the controls operating correctly? So let's say we had some sort of wages program where over 0 to 40 hours it was going to basic pay, and then for over 40 hours it was going to be a time and a half. How do we know it's operating properly? And maybe what happens if somebody puts in maybe over 60, you want it flagged up? That looks excessive. How do we know the calculations have been done right? How do we know that this warning, if you like, is actually produced, so somebody seems to be submitting a huge number of hours in a week? So what you would do is you would put in somebody who's got 30 hours. You would predict what their pay was going to be, and then somebody maybe at 40 hours. Quite often, what you do is you go with the cut off here. So if it's exactly 40 hours, what are they going to be paid? And you predict their money. And then maybe 45 hours and you predict their pay. And then maybe you put in 65 hours, and of course you expect that to be a flagged up, some sort of warning. And maybe what you even do is you maybe put in -10, just to see what happens if somebody puts in something stupid. Is the system resilient enough? What would it actually do with this person's pay? Does it try to bill them for their wages because they've worked negative days? You hope not, but until you've tested it, you don't know. Obviously, if you're processing what is absolutely false data here, you've got 4 or 5 false employees, you predict their pay, you let the program calculate their pay, you could be putting false employees on the payroll, you could be getting wrong amounts debited to the wages accounts and so on. Quite often this test data is, or the programs, if you like, you use copy files. You don't use the real files, so that the real files are going to remain kind of unpolluted by your test data. Outsourcing internal audit. As I said, this is becoming increasingly popular. Considerable advantages maybe to be outsourced. First of all, when you're setting up your internal audit department, there is no recruitment. There is, well, let's put these in here. It's really immediacy. You can set up immediately. There's no ongoing problem with replacing internal auditors who've left and worrying about promotion and so on. It's like outsourcing many sort of services. It relieves you a lot of management responsibility. You can have specialist services. If you discover a fraud, then probably what you need is some sort of forensic audit, because what you might want to do is to take the fraudulent employees to court. But forensic auditing is quite a specialist job. You need to collect evidence such that it will stand up in court and so on. You maybe need to employ specialist techniques for finding the fraud. And there's no reason why a simple internal audit department has all of these specialist services. But if you've outsourced, to PwC, KPMG, Deloitte, EY or something, one of the big firms of accountants, they will have specialists so they can draft in for this investigation. Appropriate amount of time. So maybe really only we need only one internal auditor, but that's a lonely life. Internal auditors are not always the most popular people in an organisation, because they will maybe be reporting on errors that people have made. So to give them some kind of strength and integrity, really maybe want a team of maybe 3 internal auditors, but maybe there's not enough work for them. So instead of employing 3 people yourself, you can get the external providers to send you 3 people for 3 months of the year, or whatever it takes to do your internal audit. Similarly, if you want a special investigation done like that fraud, you can really bring in a great big team of people, really blitz the system over a very short time to find out what's happening. And finally, independence. These people are employed by external firms. They are not reliant on you for their job or the promotion or their pay. It can give a lot more courage, if you like, to internal auditors if they are actually employed by an outside company. Disadvantages: cost. If you're hiring people in from one of the big accountancy firms, the charge-out rate is very substantial, and it can be quite a large cost, certainly equaling the ordinary salary of a full-time employed internal auditor quite quickly. They have less expertise, not specialist expertise, I mean here less expertise about your company. The thing about internal auditors is if they're employed by the company, they work there all the time, they get to know the company like the back of their hands, really, and less expertise is going to be evident if you're bringing somebody in from outside. They're only spending 3 months a year there. They don't quite know the company as well as employed people. And finally, not a big one to worry about here, there are complications of external auditors are used in terms of independence and self-review and so on, but there's no particular reason why that has to happen. And finally, we'll look at fraud. Fraud is an intentional act involving deception to gain unjust or illegal or dishonest advantage. Fraud can be at 2 levels. There can be fraudulent financial reporting, where a company overstates its profits. It maybe does this to increase the share price. It maybe does it because it wants to list in the stock exchange, it wants to list at a high share price, or to induce a buyer to buy at a very high share price. Or maybe it's the directors overstating the profits so that they get a much larger profit-related bonus. And then there is the misappropriation of assets, which is basically theft. Theft of cash, theft of inventory, sometimes theft of non-current assets, things like laptops. The prevention and detection of fraud, it must be an integral part of corporate strategy. The people who are responsible for this, it's ultimately going to be the board. So it's the board, not the internal or external auditors, it's the board who carry the responsibility for the prevention or detection of fraud. And fraud requires 3 things for it to work: incentive, opportunity, and attitude. So let's have a look at that, how those will come up. So let's look at the 2 separate sorts of fraud here. Fraudulent financial reporting, overstating your profits, say, and theft of assets. So, incentive or motive. It can be just greed. So here we have greed, and we can all be, I suppose, to some extent envious, at least if not greedy. It could be personal financial pressure. You know, you have to pay your rent, your mortgage, pay off your credit card and so on. So this is kind of pushing people a little bit of pressure, maybe to being dishonest. It could be feeling I want to get my own back. This person's been unfair to me, I haven't got my promotion, I'll steal some money, I should have had that pay rise, I'll steal some money to make up the difference. In fraudulent financial reporting, it could be the incentive, the motive there could be incentives, profit-related pay, profit-related bonuses, can encourage people to overstate the profits. Pressure to perform and profitability kind of threatened. There can be huge pressure on directors, particularly in listed companies, to keep the profits increasing year after year. And if they don't increase them year after year, there can be great criticism in the press and from shareholders. Then we need opportunity. For example, you can steal cash, you can steal high valuable portable stock like in a jewellery shop. If there are poor internal controls, then it's opportunity. If nobody locks away the stock, for example, or nobody banks the cash promptly, it's just kind of lying around, there's obviously opportunity. And poor IT systems. Poor IT systems where maybe you can order goods for yourself and have them sent home, yet they're going to be paid for by the company. In terms of the fraudulent financial reporting, you are giving directors and so on more leeway if there are many estimates, many elements where judgment is going to be applied. Hard for auditors maybe or anybody else to argue against their estimates. Complex transactions, it gives leeway to again kind of pull the wool over people's eyes. They don't quite understand, they can't really argue against what the directors or the managers have said. This is very important, dominant chief executives. And if you remember when we talked about corporate governance, we said that in Enron and WorldCom, one of the major causes, they thought, of the scandals that went on there was very dominant chief executive, bullying type of people who just kind of cut through all the internal controls and so on, and people would just do what they said. That's of course one reason why the roles of the chief executive officer and the chairman are separate. And again, poor internal controls. Now, we've probably all felt financial pressure. We've probably all seen in a shop an opportunity to maybe shoplift or to steal cash from a till and so on. It's to be hoped that none of us have ever actually done it, or not since we were older than about 6. And the last thing we need is basically dishonesty. It is a kind of low moral base, if you like, and we're actually willing to act on our impulses almost. So it can be just poor ethical guidance, poor ethics, inherent dishonesty could be on both sides of this here. This is quite interesting, other people's behaviour. So you join a company and you see that everybody in the company, when they're travelling around, they always travel on standard class rail fares, but they always claim first class rail fares. It's unethical. You're claiming more expenses than you really spent. It is a form of misappropriation of assets. But then you kind of see, well, everybody's doing it. And you kind of begin on this kind of slippery slope. Everybody else is doing it. Why can't I do it? And then you begin to almost justify it by saying, well, the company must know about this. Surely it can't have escaped their notice that everybody is overclaiming on expenses. What we need to do in respect of fraud is to prevent it, to detect it, and the response to it. So prevention could be, for example, simple internal controls. Lock stuff away. Be strict with passwords. Detection, all sorts of detection. Do reconciliations, for example. Examine run logs to see maybe who has been on the machine that shouldn't have been on the machine. Perhaps search people as they leave a factory to make sure they haven't got raw materials or valuable tools concealed, in their clothing and so on. And then third, there's a response. What are we going to do about it if we find that a fraud has been perpetrated? We've detected it. Maybe it's gone on. We haven't prevented it. We detected it a bit late. Some money has been lost. We, of course, want to establish how much has gone, for what period, how was it done, because we want to plug that hole. Who were the perpetrators? Who suffered losses? Because sometimes it might be a customer who suffers losses, or maybe a supplier who suffers losses. We don't necessarily know. It could be the government that maybe suffers losses because there's been some fraudulent tax claim by an employee. Can it be prevented in the future? We also have to think, what do we do? What are we going to do about these perpetrators? How are we going to take them to court? What sort of disciplinary procedures are we going to operate on them? And I suppose, big range here. If it was a small, one-off claiming a taxi fare when really you didn't ride in a taxi, you went by bus and so on, people might give you a warning, a stern warning that goes on your record and so on, and hope that's enough. In some companies, they would see that any little bit of dishonesty, no matter how small, really meant that they didn't want to be associated with that person, and then maybe you get the sack. In frauds of greater amounts and greater seriousness, you have to think, do you want to involve the police? Take this person to court? And many companies prefer not to, because they think involving the police and the publicity that comes from that is going to give their company a bad reputation, and they'd rather just kind of quiet it down, see if you can get the money back from the fraudster, and then sack them. And make sure everybody knows about it if you can. You need to advertise to your employees, really as part of the prevention mechanism here. You want all your employees to know that any incidents of fraud will be treated really, really seriously. And this acts as a really good deterrent in fraud.